welcome everybody to this webinar run by the Institute of Finance and Financial Regulation. We have the honor to have with us today Mr. Amin Rajan. Amin is a distinguished speaker, high-profile consultant, and a frequent columnist in the Financial Times. Before starting, let me set the ground rules. So please have your cameras and microphones off. At the end of our conversation with Amin, we will have the chance to take questions from you. So you can either write your questions in the chat section, and then I'll read it out for you, or alternatively, you can raise your hand. So on the top of your screen, you can find the raise hand function. And once you click on that, you can raise your hand, and then I will unmute you, and you will be able to pose your question verbally. So I know that everybody is tired. It has been a long day today. And on top of that, we have so many webinars. So we thought with Amin to do it in a different way this time and put some flavor. So what we're going to do is we're going to have an in-conversation where at the same time Amin has offered kindly to present some of his slides. I should say in advance that the slides you will see are based on a survey which Amin again very kindly will offer it to you in a soft copy. So if you wish, you can receive it by email. I should also say that this meeting is recorded. And before starting, I should also acknowledge the valuable support by our partners, in particular this time by Olcus Investments, by Piraeus Mutual Fund Management Company, by Systemic Risk, and by Alpha Trust. So I think we can start now. And Amin, feel free to say a few words about yourself. I think that will be safer instead of me introducing you.
Okay. I'm chief executive of a research boutique based here in UK called Create Research. It was established about 32 years ago. And for the last 20 years or so, its main focus has really been on asset allocation models in the world of investing. Every year, we do 3 or 4 major surveys involving institutional investors and asset managers around the world. And our main focus is really to find out, what is new, what is different, what is likely to happen 3 or 5 years down the line, and so on. So our work is always focused on asset allocation, and it's always very forward-looking. And we have all our survey reports published, and they are available on our website. And also, as well as producing those reports, we have lots of articles as well in journals like Financial Times and IPE and Bloomberg and so on. And these are also available on our website. So feel free to have the access the information that you want.
Great. So what was the motivation for conducting this survey? I understand that this is a survey on pension funds and portfolio construction in light of COVID-19. So what motivated you to do this survey? Is it the first time that you deal with pension funds? Has COVID posed any challenges for the purposes of conducting the survey?
No, we do 3 key surveys every year of institutional investor. And this survey is meant to be our winter survey. For example, we brought out the spring survey back in March, which looked at the investor sustainability journey. Then we brought out another survey in June, which looked at how investors were investing in climate change by using passive funds. So this is our 3rd survey, which is our sort of regular annual survey. What motivated us, it was the fact that we publish this survey every year at the time of the IPE conference, which takes place in December. And as you know, IPE conference is Europe's premier institutional investor event. And there we present the results of our survey. So that's part of the motivation for doing the survey was very much about, it is really part of what we do every year. But the key motivation for the topic on COVID was the obvious one. Back in March, it was very clear that this crisis that we had entered, it was deeper, darker, and scarier than anybody had ever imagined. This is a once in 100 years type cataclysmic event. And as a result of that, it was hard to believe that nothing was really going to change in the world of investing. So what we decided to do was to make COVID-19 as the centerpiece of our survey and try and find out three things. One of them was, how is COVID-19 and the policy response to it changing various macroeconomic variables, and what kind of macroeconomic shifts is it trying to bring about? The second thing was really how is the world of investing is likely to change for institutional investors? And thirdly, what kind of asset allocation approaches would be adopted, both in terms of asset classes, in terms of asset allocation tools like risk factor investing, asset vehicles like passive funds, and also asset themes like ESG. So we basically wanted to know how each layer of investors' asset allocation was likely to change as a result of this crisis.
Okay, I guess we'll have the chance to see what kind of responses you received. So before getting into the responses, would you like to tell us a bit more about the demographics of your survey? What kind of pool are you using? Where is it located? The seniority of respondents, the assets under management by these funds you're looking at?
In terms of demographics, let me just start with the numbers. We had 158 pension plans from 17 different pension jurisdictions around the world who participated in the survey. The biggest representation was really from the 9 key pension markets. Together, they accounted for something like 2 trillion of assets, just slightly south of 2 trillion of assets. In terms of the sectors, about 75% came from private sector and 25% from public sector. And in terms of the types of plans, just over a third were DB plans, another third were a DC plan, and the rest were hybrid DB-DC plans. So we had a good representation in terms of sectors and in terms of types of plans and in terms of their geographical coverage as well. And these demographics are sort of very much in line with all our annual surveys. We try and target key pension plans in all the jurisdictions. And the results that we present here are very much focused on what is it that they're really doing and what their forward views are.
Okay, great. So I guess we can start now by showing the results of your survey. You said previously that the first question you are looking at is with regards to the effects of COVID to the economy and to the financial markets. Would you like to show to us some indicative pictures?
Yeah, I think before I start with indicative pictures, let me make a very important point, which really was a sort of overriding point that came out from our survey. And that is that COVID-19 has well and truly wrecked pension finances. As things were before the crisis, pension plans in all the jurisdictions were really going through a very difficult time. They were going through a difficult time because in the last decade, as you know, we had interest rates going from something like 6% at the beginning of the last decade to something like near zero by the end of the last decade. And this continuous decline in interest rates really played havoc with plan liabilities because the discount rate that they were using for discounting the future liabilities was continuously dropping. And as a result, the deficits were rising. Of course, falling interest rates had a positive effect on the asset side. But even if you allowed for that, every 1% drop in interest rate has a net effect on fund deficits of something like 10 percentage points. So falling interest rates were a major factor behind the fact that most plans went into the current crisis with finances that were weaker than they were at the time of the previous crisis back in 2008. And this difficult situation was well illustrated. For example, in the US, the Pension Guarantee Corporation, which ensures the solvency of United States pension plans, had warned last year that its biggest multi-employer pension plan was likely to go into insolvency by the year 2025. This is before the crisis started. They were already predicting that something like 10 million members were really going to lose their pension entitlement. As if that's not enough, if we come to the second biggest pension market in the world, which is UK, the Pension and Savings Lifetime Association had warned that something like 40% of members of the DB plans in UK will not really be getting their full entitlements. In fact, they will really have to take big cuts in their pension benefits and so on. So this was a situation before the crisis. And as we went into the crisis, plans were hit by a double whammy again. On the asset side, values of assets really dropped very dramatically. And although they have recovered in many instances, the recovery is very narrowly varied, and it's sort of very much focused on tech sector and healthcare sector. Large number of other sectors are still suffering. So that was a whammy on the asset side. Then on the liability side, interest rates dropped even further. And that again had the effect on pension liabilities and also affected pension plans' ability to fund their regular payouts. So to start with, they already went into this crisis with worse finances than they did in the previous crisis. So against that background, if I can now come to your question. What we tried to do is to sort of find out how COVID-19 crisis was going to cause various shifts in the global economy over the next 3 to 5 years. And it was very clear that, there was going to be a shift from freer markets to more governmental intervention. And this sort of intervention is likely to be around for quite some time to come, because the government help for businesses has come with strings attached. And so government intervention is really going to be there in areas like governance, in areas like dividend payments, in areas like share buybacks, in areas like M&A, and so on. So we're going to see far greater government intervention than has been the case in the past. Secondly, there is every likelihood that central banks would lose their independence, because what has really happened is that government and central banks have embarked on a stimulus of the order of $20 trillion. This is equivalent to 25% of global GDP. This is the biggest stimulus in peacetime history that we've ever seen. And it's the biggest collaboration between central banks and governments that we've ever seen. As a result of that, governments are going to have to rely on debt monetization on a very significant scale in order to fund their deficit. In other words, central banks may well lose their independence as they try and control interest rates across the yield curve. The control of yield curve, complete control of yield curve will be necessary in order to fund the deficit. But if central banks try to do that, the inflationary expectations may become unanchored. And this will have consequences in a way that I'll just describe in a minute. Thirdly, we're likely to see a shift from globalism to nationalism. This was already happening before the crisis, with the Brexit vote here in the UK, and then the election of Donald Trump in the US, marked some very significant steps in the direction of rising nationalism. And as a result of that, what we're seeing is a world which is becoming smaller in terms of trading, and it's becoming meaner in terms of its ability to cooperate with different countries and so on. So, that is another shift that we're likely to see. The third shift is really from deregulation to re-regulation. And that will be very much as a part of the sort of greater governmental intervention. And we're likely to see, a lot of emphasis now put on not so much wealth creation, but on wealth distribution. We will see a very strong shift from wealth creation to wealth distribution, largely because COVID-19 have exposed glaring inequalities in our societies. And finally, we will see the shift from deflation to inflation. And that is likely to occur largely as a result of central banks losing control of inflation. The control of inflation will pass to central governments as debt monetization progresses. So we're in a situation where, we're likely to see some major shifts, which will see greater governmental intervention, less influence from central banks as far as share prices are concerned, and seeds of inflation being sown. I'm very conscious of the fact that we're in the middle of a major deflation at the moment, and it's hard to see inflation rising. But what is really feared is the fact that central banks would lose control over inflation, and secondly, we don't know how big a damage there would be to the supply base of the global economy. So it may be that the governments will need to throw a lot of money to revive economies, particularly if the supply base is permanently damaged. So there are quite a lot of known unknowns, but the central scenario here is central banks losing control over a period of time, inflation arriving, and as a result of that, what we will see will be asset prices reverting to their fundamental. But I'll come to that in a minute. Let me just make another point to substantiate what I'm saying. Okay, markets are booming at the moment, but we don't know the damage that has been done to the supply base, and it is very likely that governments will have to intervene on a gigantic scale again and restart inflation. And as a result of that, as far as our survey respondents were concerned, they expect a W-shaped market recovery. W-shaped in the sense that the recovery is interrupted by lapses, so there is an improvement followed by lapses, or an accordion-shaped recovery in the sense that, there will be a lot of mini bull markets within a prolonged bear market. So we are in a situation where a lot has not been factored into the way markets are operating, and we're into completely the realms of the unknown. It was very interesting that one of the respondents said that looking at this corona crisis and trying to assess its effects on asset allocation is really like looking into a kaleidoscope. As you change the dial in the kaleidoscope, a new image occurs. And as the crisis has progressed, as corona crisis has gone from the first wave to the second wave, what we've basically seen is really new narratives emerging. But the latest narrative is really that this vaccine is very welcome, but it's not really going to have a dramatic effect on the economic fortunes well into 2022. Partly because we're not sure how many people will be willing to have the vaccines, partly also because we don't know how effective the vaccine is going to be, partly because we don't know how this coronavirus is going to mutate and whether a new form of vaccine will be needed and so on. So there are a lot of known unknowns about the current situation. And in the meantime, what we expect to see is volatility returning.
I see. So you mentioned that some of your respondents at least believe that in the coming years, there is going to be some reversion of asset prices to their fundamentals. So this implies somehow that currently there is some sort of mispricing in the stock market, for instance. Actually, there are some academic studies, which very recent studies, which find that there is no sort of mispricing in the US equity markets. Does your survey shed any light on the consensus on whether there is some sort of mispricing, and how long do your respondents believe that this reversion is going to take place until we see reversion to fundamentals? Okay.
So first question is about mispricing and the second one is about fundamentals. Let me take the first question. Yes, definitely, there is across the board consensus that asset prices have been fundamentally overvalued. As you know, what happened in the last decade was that, we had successive rounds of quantitative easing. The aim was to push investors up the risk curve, get them into the risky assets. And as a result, there have been investors have been moved up into risky assets because the alternative was worse. And as a result of that, there have been a lot of conviction-less trades. And that's why markets were so jittery. When market fell in March, the collapse was something that has never been experienced in history, because This market is completely convictionless. So when it comes to mispricing, yes, assets are severely mispriced at the moment, largely because of what central banks did in the last decade. So we went into this crisis with hugely mispriced assets. And then what happened was that the correction was absolutely violent. And yet this correction the correction was violent, but the upturn was very rapid as well. And it was rapid because of the sheer amount of liquidity that was pumped into the markets by the central banks, and particularly by the Federal Reserve. Federal Reserve, let's not mince words, has effectively nationalized the bond market in the United States. And it's as simple as that. So, you can't really misprice an asset any more than simply nationalizing it and raise its prices to levels which are so far removed from the fundamentals. So mispricing has been rife. To come to your second question about what is likely to happen as a result of that and whether we will see mean reversion. A number of points really came out from our survey. The first point was that asset returns will be a lot lower compared to the last decade. They will be a lot lower because QE of the last decade had fundamentally borrowed against future returns. In other words, returns were brought forward from the future to the present. And therefore, markets will remain in a low return era for quite some time to come. And that was one reason. The second reason is the sheer uncertainty about when economic recovery will arrive, how durable it will be, whether we will go back to pre-2020 level anytime soon. Because as it was, before we went into the crisis, most economies were really firing only on two cylinders. They really hadn't reached their economic potential. So the next question is, whether they will really come back to their long-term trend line or whether they will continue to operate below the trend line. And then the third one is really about central banks losing their potency in artificially setting market prices. This really sort of assumes really that once central banks become a department of the Treasury, they really will lose control over inflation, and they will really lose control over much of the monetary policy. So there are real concerns that central banks' potency will weaken, both in terms of setting market prices and also in suppressing volatility. So we are entering an era of low returns and high volatility. And in that situation, asset prices will reconnect with their fundamentals. And there is very strong consensus that this kind of markets, which are so unreal, cannot really last for long. The valuations are so unreal that they can't really last for long. And more investors are recognizing that. But in the past, they thought, Federal Reserve in the US and European Central Bank will be able to provide the necessary backstops for the market. They'll be able to provide a floor below which prices cannot fall. They will be able to suppress volatility. Now, those things are not really likely because central banks are set to lose their potency. So in a situation like that, we may well see the reconnection of asset prices with their fundamentals. And this really then changes the way investors want to invest. And more about that we'll come to in a minute.
Okay, so actually I was about asking this in the interest of time as well, so that we engage the audience later on. So given this outlook, how do your respondents feel about the kind of investment strategies and risk management tools to use? Does COVID change the practices we knew so far with respect to investment strategies and risk management?
Yeah, so the idea that we are no longer in the environment of the last decade is very much reflected by two lots of statistics. Let me start with the first one. What we try to do is to find out how likely is it that COVID-19 will mark a turning point in how investing is done. And, opinion were divided. A third of the respondents said, nothing is really likely to happen. And their view was very much that, there is so much uncertainty now, and the best thing was to do nothing and just hang on to the assets that they've got. Then there were 37% who said, things could really change. Or there was 30% who reckoned that things could change very much. They were really quite certain. The last two groups believe that in order to survive in this decade's environment against the environment that I have outlined, they really need to have much more resilient portfolios. And resilience is fundamentally about factoring in the post-COVID future into the present. It is really about being on the right side of change. And they expect to be on the right side of change by investing in companies which are really likely to emerge on the other side, stronger and more sustainable. And how are they going to do that? First, they are likely to rely on private market strategies, because in private markets, you can actually build in your idea of resilience into the covenants. So covenants are actually customized to the extent that they take into account an investor's desire for resilience. The second way of building resilience is really adopting thematic strategies, because these strategies themselves are inherently, they seek to be very resilient. And the key thematic strategies here are ESG, for example, technology, healthcare, urbanization, and so on. These thematic strategies basically focus very much on isolated bright spots in the global economy, which will allow investors to ride out the market cycles, because these growth points are really going to perform very well. So thematic strategy is another area. Then the multi-risk factor strategies, these are also seen as helping out quite a lot, because in periods of volatility, different risk factors are likely to perform differently. So the idea here is really to use the multi-risk factor strategies. And then it's the cash flow compounding strategies. These are strategies which rely on quality factors. Companies which have got strong cash flow, they've got good pricing power, they've got a good brand, they've got a good market position, and so on. And then there is the investment grade credit with policy backstops, because central banks are backstopping a number of types of bonds. So they provide resilience as well. And then emerging market strategies are also seen as providing resilience, because emerging markets are likely to bounce back from the current recession far more quickly and far more on a sustainable basis than their peers in the West. So that is the way to achieve resilience. So resilience is now becoming the third element in asset allocation, in addition to risk and return. The fourth element is really coming through the risk tools. And now the risk tools are likely to rely much more on scenario planning rather than backward-looking risk models, which rely on probability distribution of asset prices in the past. They are going to be much more forward-looking. And finally, a lot of emphasis on liquidity management. Liquidity will emerge as the fourth pillar of asset classes alongside resilience. So a lot of emphasis on resilience and a lot of emphasis on risk tools which are forward-looking, and also risk tools which rely heavily on liquidity. This focus on liquidity is for two reasons. One is really that in the period of extreme volatility, portfolios can get whipsawed. So it is really good to make sure that there are liquidity buffers in the portfolio against a scenario like that. And secondly, with heavy volatility, there are going to be many buying opportunities, and therefore liquidity buffers can really help in that respect as well. So the way investing is really going to change is really extreme focus on resilience and extreme focus on risk tools, which are much more forward-looking than backward-looking.
That's very interesting. I mean, the extra dimension of resilience you're bringing up in a way reminds some very recent advances in asset management, where people nowadays incorporate ESG in their portfolio construction. And instead of having the standard Markowitz mean variance setting, now we're in the 3 dimensions where you have expected returns, risk, and the ESG dimension that many people nowadays relate to the resilience dimension. But we're going to talk about ESG at the end. So just to wrap this up, so you told us that about the investment strategies and the risk management tools. How about the asset classes? So where are these guys going to invest their money? In what kind of assets?
Yeah. Okay. So there is going to be, as I said, much more focus on scenario planning, and that basically sort of means that the risk models which were used in the past would be heavily augmented with different kinds of tools, and that is becoming very evident from if you look at the major events that have occurred since 1981. For example, we've had 15 major market events which were not predicted by the existing risk models. Since 1981, there have been 15 of these events, and there were 6 which were the absolute outliers. None of them were ever picked up by any of the current generations of models. And so as a result, going forward, a lot of emphasis on scenario planning and a lot of emphasis on selectivity as well. What investors are planning to do is to pursue one or more of 4 objectives. The first objective is really capital growth. The second objective is really to have decent income in order to pay out the pensions as plants are maturing and as a result of the demographic changes. And the third one is really about inflation protection because the fears of inflation are there in the background. And the fourth one is really about capital conservation. So they're trying to achieve these 4 objectives by, first of all, as far as the capital growth is concerned, the emphasis on really global equities and high quality equities and private equity. So these are in the top 4 categories. As far as income is concerned, the focus is really on infrastructure and corporate bonds, and also on private debt. As far as inflation protection is concerned, the emphasis is really likely to be on infrastructure and on equities. And as far as capital conservation is concerned, the emphasis is really likely to be on government bonds. As you can see, government bonds really rate very low in the rank order on the chart on the right-hand side. The interest in government bonds is likely to come from those pension plans who have got very good funding ratio, and they want to completely de-risk their portfolios. And as a result, they would like to go into sovereign bonds. But when you look at US government bonds there, for example, also when you look at the US equities, there is not really a great deal of interest at the moment in the US assets, simply because they are heavily overvalued, as I mentioned before. The Fed nationalizing the bond market and also Fed buying ETFs as well. It really doesn't really make much sense to really think about, those assets lasting or having a lasting return characteristics. So that there is sort of real worry that government bonds are really there only for those pension plans who want to completely de-risk their portfolios. Now, this betting order here is very different from what we've had in the past. For example, private equity has rated very highly, but now there are worries about private equity in the sense that it is a very high dispersion space. The difference between the best performers and the average performance is getting bigger and bigger. So manager selection is absolutely vital. And there is also a lot of survivorship bias in the data there. So you really got to be very careful about looking at the private equity data and when you're doing manager selection. The other big change from previous years is private debt. It is on the left-hand side, somewhere in the middle batting order after emerging market equities. Private debt has featured very highly, but this is another asset class like private equity, where the current level of dry powder is extremely high. It's about 1/3 of the total assets in that universe. 1/3 of it remains to be unallocated because what happened in the past decade, as more and more money was going into private debt, the covenants became very light. And as a result of that, there are real worries that many of those investments are going to turn into distressed assets. So insofar as there will be interest in private debt, it will be from the angle of not new issuance, but it will be from the angle of changing the distressed assets. So there we are, great selectivity in terms of capital growth, income generation, inflation protection, and capital conservation. And you know, there are some asset classes which are really likely to do extremely well, and that is already evident. If you look at global equities, you know, global equities are really running the show at the moment in stock markets, and particularly those global equities which are really related to tech and healthcare. They are doing extremely well at the moment. But there is expectations that, you know, consumer staples and industrial materials, they will really join the ranks before long as the economy picks up.
Right, so that's very interesting. So I guess we still have 5 more minutes before we take questions from the audience. So far, I guess we have covered 2 of the 3 key topics that your survey touches upon. So the third topic you mentioned earlier has to do with ESG and pension funds. Yeah. So ESG is something very trendy nowadays. Everybody's talking about ESG. People rush after it. But at the same time, it seems, at least to me, and you know, as an academic reading the academic literature, there is a dichotomy. So people are not sure, after all, whether ESG helps long-term investors like pension funds. So the analogy is to play basketball with one hand, because effectively what you are doing is you are restricting your asset universe. Yeah. On the other hand, you know, pensions in many countries like Canada advocate a decarbonization, for instance, policy strategy. Their argument is that by investing in good companies, resilient companies, as you call them, this will make them better off in the long run. So how do the respondents feel about ESG? I guess in the next 5 minutes or so, we can talk about it. What are the key takeaways from your survey? Okay, just 2 points. Let me just give you quick takeaways and make a comment about the dichotomy that you referred to. Okay, as far as ESG is concerned, let me just make 4 very quick points. 1, the current share of ESG in pension portfolios is significant. You know, over 30% of assets, 50% of respondents have over 30% of their assets in ESG type assets. And if you then bring in the next layer, you know, something like 80% have got ESG as 80% of their portfolio. So ESG is no longer peripheral to the portfolio. It is very much a core part of the portfolio. My second point, this percentage is, if anything, likely to grow. 82% expect to increase their ESG allocations. So not only the allocation is significant, but it's likely to rise even higher. My third point, we try to find out whether ESG portfolio had performed better than the rest of the portfolio, or same as the portfolio, or performed worse than the portfolio. And you can see 52% reported that it performed better than the portfolio, and 45% reported that it performed the same as the rest of the portfolio, and only 3% report that it's worse than the portfolio. And the final one, the final point I want to make is we try to find out, you know, which of the ESG components was very important. And 41% argued that it was environmental, 30% social, and 29% governance. Now, these figures in themselves, you know, don't really mean anything. But if you compare them to a similar survey that we did 2 years ago, the emphasis on social has gone up from 12% to 30%. And that is largely the COVID effect. You know, people have really seen how devastating an effect COVID has had on different societies. So the social component has really gone up quite a lot. So as far as the results are concerned, you know, the survey results suggest that investors are very happy with their ESG portfolio, and they're going to invest even more. Now, to come to your question about dichotomy, I think, you know, the academic evidence does tend to be backward looking. You know, most of the research methods that they use try and look to see what has really happened in the past. And ESG, if you test ESG as a risk factor, like a traditional factor like quality or value or momentum, then it is not a risk factor, because we haven't got a long enough data series
for ESG to be proved a risk factor. But what has happened is there was a watershed moment in 2015 when the UN 17 Sustainable Development Goals were adopted and when Paris Agreement was signed by nearly 200 nations. And since then, pension plans have been paying more and more attention to ESG, in part because of those monumental changes in that year, but in part because of regulatory pressures as well. For example, in UK, now, if I'm a chief executive of a pension plan, I really have to make sure that I have complete data on what my ESG footprints are and what I'm actually doing to increase these footprints. For example, when it comes to governance, the onus is on me to prove to regulators that I am engaging with the companies that I have invested in to make sure that they're improving their ESG footprints. So regulatory pressure has been there as well. Now, these are the sort of things, these forward-looking things are the things that are really missed out by academic research. But I have no doubt at all that as we have more and more data, I think this dichotomy will disappear. Indeed, one study that was published by Amundi last year, it basically sort of showed that ESG is a risk factor in Europe, but it is not in North America or in Asia Pacific. And so what we're sort of seeing is a movement here in that particular direction. And my view is that that dichotomy will really disappear as we progress during this decade, because investors are putting money here, not because they really want to sound like a climate warriors or anything. They first and foremost want to invest in ESG because they reckon that ESG really delivers better risk-adjusted returns. And most importantly, it really gives you a more defensive portfolio. ESG may be closely related to quality factor, but quality factor, for all its virtues, is backward-looking, and ESG is forward-looking. And at the very least, ESG delivers a very defensive portfolio. So that's the way this dichotomy is explained, George.
That's very interesting. I mean, that's why it's always so interesting, that academics interact with high-profile practitioners like yourself, because we learn many things. So, recently in 2020, a survey was published in one of the top academic journals in finance, in the Review of Financial Studies. Their pool of respondents was including pension funds as well as mutual funds, and the sample was biased towards mutual funds. And one of the key findings of this survey is that mutual funds do not really care about, for instance, climate change risk. So when they were asked, they ranked it something like in the 5th or 6th place compared to other sources of risk, like financial sources of risk. I guess the key difference here with pension funds is that the investment horizon is much longer. Yeah. And as you said, ESG is a forward-looking measure. So at the same time, regarding climate change risk, we have evidence that the prices of houses which are next to the coasts do not incorporate a premium for the risk of the level of sea rising in the coming year. So these are still very much open questions, but your survey is definitely very interesting, and I'm sure that people will discuss it further. Yeah. So we can stop here our conversation. I would like to thank you for your patience. And now I guess we can start taking questions from the audience. As I said, you can either raise your hand and we'll come to you, or you can simply pose your question over the chat section. So feel free to pose questions. At the same time, I'm checking whether anybody has raised hands. Let me check. It's a long list of attendees. So, okay. We have a question from Theodore Economou. Hi, Theodore. Let me read it out for you. The developments in asset allocation identified in the survey will require a step up in sophistication by asset allocators. How equipped are smaller pension funds to deal with this, and what will they need to do?
Yeah, a very good question indeed. Yes, it does really require upgrading not only the skills levels of a pension plan, but also its governance structures. Because I think as we go into a high volatility environment, we're going to have a lot of risk on risk of trades and so on. And it will require a lot of expertise to interpret what is really going on. So you're absolutely right in terms of these new requirements. How can small and medium-sized pension plans take care of that? Well, most of them can do one of two things. One is really to use fiduciary managers, because more and more small and medium-sized pension plans are now appointing fiduciary managers who got expertise right across all the asset classes. And these fiduciary managers do everything from asset liability modeling to asset allocation to manager selection to reporting and so on. And so, fiduciary managers segment has really been growing quite considerably in markets like Netherlands, here in UK, and even in the US, it is really taking off. So more and more small and medium-sized pension plans are now teaming up with the fiduciary managers who've got all the necessary expertise. So that's one area. I think the second thing that they can do is really to sort of form some kind of alliances with their asset managers. What I find is that there is a big, deep blue sea between asset managers and their pension clients. Asset managers are seen very much as distant vendors, when in fact they should be really used as thinking partners. And more asset managers are setting up capabilities in the client service area, where they do provide a lot of investment expertise and investment information to those pension plans who have invested with them. So, for example, I know a few asset managers who will give me a second opinion on my asset allocation, for example, because I'm invested with them in one particular strategy. They will look at my total asset allocation, and if I needed a second opinion, they will give it to me. If I wanted them to do some research for me, they will do it for me. But that would only happen if there is a very strong alignment of interest. And by alignment of interest, I don't just mean financial alignment of interest, where fees are paid on a meritocratic basis, but I also mean non-financial alignment of interest, where asset managers share with pension plans the time horizons of the strategy and also their investment beliefs. Because what has really happened with small and medium-sized pension plans is that there has been a tendency to panic. They displayed quite a strong herd instinct. Every time there are problems in the stock markets, they really run for the cover. Without sort of realizing that there are some strategies which are likely to come good only over a certain period of time. And they really need to share the time horizon and investment beliefs with their asset managers, such that there is no panic buying and panic selling. So alignment of interest needs to be widened to include non-alignment issues like beliefs and like time horizon. And more and more small pension plans are doing one of those two things. But it's a problem. There is no doubt about it. And more of them are also resorting to passive investing. Passive investing, may help to a certain extent to access resilient companies. But if you're really looking for alpha opportunities, passive funds by definition are not really likely to deliver that.
Thank you, Amin. Another question is posed by Mr. Alexis Andriopoulos. So the question has to do with tail hedge investment solutions. And the question is whether these kind of solutions can be included in the pension fund planning and be profitable in the long-term horizon.
Yeah, and by tail hedge solution, you basically sort of mean, hedging the tail risks, the negative tail risks, yes?
Yes.
Okay. Now, what has been a major surprise to me, for the last 6 years, we've been asking one simple question, which is, what risk tools are you using? And what has really been surprising is that the use of tail hedges is very minimal. Number of reasons for that. One reason is that, first of all, they're very expensive. Second reason is really that you cannot buy hedges right across the portfolio. You can only buy hedges for certain asset classes. So if you really try and hedge your entire portfolio, it really becomes prohibitively expensive. And the other thing is that these hedges, they are really not as viable as we like to think, because when something goes wrong, the counterparty, if there are too many hedges that they have to respond to, the counterparties can go out of business. We found that with the American Insurance Group back in 2008. You know, it had issued large number of tail hedges, which it couldn't really honor, because all these hedges simultaneously matured with the collapse of the Lehman Brothers. And AIG found that they couldn't really honor their obligations, and they went out of business, or they were bailed out by the US Treasury on that particular occasion. So there is distrust of these tail hedges, and instead the emphasis is very much on having a broad-based asset class, on really having liquidity buffers, and also doing scenario planning, and also using factor investing instead of asset class investing in order to genuinely diversify your risk. So there is much more emphasis on non-tail hedge solutions to cope with tail hedges, or to deliver tail hedges rather, than to really buy explicit tail hedges. I'm not sure whether I made sense or not, George.
Yeah, you did. So another question is coming by Mrs. Katsani. So the question in a way is a bit philosophical, but it's very interesting. So the question is, how can one relate a temporary event like the pandemic event to macroeconomic phenomena and draw some useful conclusions out of this?
Yeah, it's a big question. And it is possible to draw macroeconomic conclusions from the coronavirus, because coronavirus has hit every aspect of the economy and the society. It has hit people's pockets, it has hit people's jobs, it has hit people's livelihood, it has hit people's health, and so on. So it should be possible really to work out what the effect of this is going to be on GDP to start with, what effect it's going to have on unemployment to start with, what effect it's going to also have on precautionary savings to start with, what effect it is also going to have on physical investments on the part of companies to start with, and also what effect it's going to have on the survival of many companies who might not be able to make it to the other end of the crisis. So there are various models which are now being run to find out what the macroeconomic effects are. But I think the key effects are really sort of coming through consumption and through unemployment and through capital formation. That these are the three variables that are attracting a lot of attention. The other variable that is attracting a lot of attention is really government expenditure. How is government expenditure trying to cushion the blow, which is being felt by the other macroeconomic component like consumption, exports, and investment, and so on. So there are models which can actually estimate what the macroeconomic effects are. And from that, we can estimate how this is going to affect corporate profitability, and therefore how is it going to affect asset values, both in the bond space and also in the equity space. So the current generation of models are capable of doing very significant simulation analysis, which can generate some clear and detailed insights into how the economy is really likely to go forward from here on. And, likes of IMF, for example, and national governments, they do invest very heavily in these models. So we've got the capability to have a fairly good idea about what the effects are going to be once we know more about some of the unknowns around the vaccine. Like, for example, when will the vaccine be available on a mass scale? How effective it'll be? How many people will agree to have the vaccine? So these are some of the known unknowns. But once we know these unknowns, then we can really begin to have a very clear idea about how bad the situation is likely to be. My own feeling, I used to construct macroeconomic models in the UK Treasury. So I've got some experience in this area. My own feeling is that, I don't think we can expect significant improvement in the year 2021, because these known unknowns are likely to prevail for the foreseeable future. But, from 2022, we're really talking about a different scenario, a different story.
Okay, thank you. Let me see if there are any other questions, or if anybody has raised her or his hand. Okay, there we have one. Okay, so that's a question from my colleague, Michael Anthropoulos. So the question is, you mentioned that pension funds have started avoiding the US equity market, which keeps rallying. Do pension funds sell their US equity portfolios, or will they do so in the near future?
Equity markets in the US are very much driven now by retail investors, the day traders. If you look at the amount of money that is coming into the equity market through what is called the Robinhood platform, which enables retail investors to invest directly into companies. And, it is a sort of very low cost robo-advisor platform. And so US market is not driven by institutional investors. It is driven very much by day traders and retail investors. And that's why the market really is very frothy, and we can expect some correction before long. Are institutional investors getting out of the US market? They are certainly not increasing their weighting to US market. In fact, I know quite a few who have actually got out of the US market, when the markets were doing really well, and they have rebalanced towards Europe, and they've rebalanced towards some of the Asiatic markets as well. So US equities are very much favored by US investors. US investors tend to be not very internationally oriented in the way that European investors are, or the Asiatic investors are, simply because the US market itself is so big that they don't really need to look outside the US market. Having said that, I think we will see US market doing well if the Federal Reserve started pumping in more money into the system. There are rumors that Fed may start buying equity ETFs in a way that the Bank of Japan has done in the past. And, that could be a game changer. But you can imagine what sort of distortion there would be in the market when Federal Reserve buys ETFs, and that kind of thing doesn't really inspire much confidence. So my own feeling is, that US market is the one which is worth watching, but it's not worth getting into at this stage. It's too frothy.
Okay, we have, I guess, time for one last question. Let me see if anybody has raised his hand. Okay, so so the last question is the following: the elephant in the room for the next decade is likely China. What are your respondents thinking about China?
Very interesting question. China is a wild card. It's got a lot going for it. If you look at its breathtaking progress in the area of technology, healthcare, advanced electronics, chemicals, and so on. China has made a huge amount of progress. But on the flip side, the Chinese economy is very much supported by a huge amount of debt. And it's a matter of time before this debt is going to unwind. And at the moment, it's not very clear whether we're really going to see some kind of a credit explosion in China or not. So whereas China looks good on a 2 or 3 year horizon, looking further than 3 year horizon, there are a lot of problems that could hit China as we go into the future. Now, one of these problems is this explosion of debt. The second one is really the way the political system is configured at the moment, that as societies become richer, people demand more freedom. And we saw that in Hong Kong. And I'm not really quite sure whether the Chinese government is going to be able to suppress people's desire for freedom for a long period of time. It's doubtful to me whether this communist system can really carry on in a way that it has for the last 40 years or so. Nothing lasts forever. Trees don't grow to the sky. And I think a time will come when we'll see a big correction in China. But I'm cautiously bullish on China for the next 3 years. I think its recovery from the crisis has really been quite dramatic. They are predicting 8% growth next year, and so China is going to be a swing factor in global growth next year, like it has been for the last 10 years or so. But the political system and the credit boom in China really argue for caution. They are the seeds of instability in China, and they can't really carry on in a way that they have. Something has got to give.
Okay. Just a final question popped up. I was about calling it a day, but I see there is an interesting question here. So you mentioned in your survey that ESG investments, so investments in stocks with high ESG ratings, did really well. The question is the following. ESG ratings exist for a recent time period characterized by low interest rates and high fiscal support. Mm-hmm. Is the performance of equities with high ESG ratings correlated by the current macroeconomic environment? I guess the question really is about whether the outperformance of high ESG scored companies merely reflect, the macroeconomic environment rather than being, a reflection of a genuine risk factor.
Yeah. Now, that was the question I addressed in our last year's survey, because my point was the money that was going into ESG. I had argued that the real test of ESG is not based on the amount of money that was going in while markets were booming and the macroeconomy was doing well, but its real test will come in a crisis. Whether in the crisis ESG will really have the shock absorbers that people think it has. So my view was really that we had to wait until the next crisis. Well, we had the next crisis in March this year, and ESG investments really, held on fairly well. If you look at ESG returns on a relative basis, ESG returns, the ESG did far better on relative returns basis, and also the outflow from ESG funds were far less than what we were expecting. So yes, macroeconomic environment has helped, but I think there is a sea change in the attitude now. And I mentioned those defining moments in 2015 with the arrival of the Sustainable Development Goals and also the Paris Agreement. But also last year, you'll remember that the Business Roundtable, which is a group of top business people in America, they put out a statement which took my breath away last year. And what the statement said was really that, today's capitalism, it really lacks a social expression. It is too much oriented towards shareholders and not towards other stakeholders in society. And what they argued for was really that the capitalism should now take into account the interest of all stakeholders, not just shareholders. Now, that kind of capitalism, which had prevailed since Milton Friedman wrote that famous essay in New York Times about 50 years ago, I think we're sort of seeing the death rights of that kind of capitalism. And there is, the biggest legacy, I think, from my perspective, the biggest legacy of COVID-19 is really going to be this mindset shift, that the old ways of investing are not really going to deliver good returns. What we really need is a system reset if we are to pay pensions to millions of people over the next 20 years or so. And the systems reset, I think, is really starting to happen with this new pronouncement from the Business Roundtable. And this then has been followed up by governments who are now really putting a lot of emphasis on ESG. And they're also putting money where their mouth is. I mean, in UK now we're going to go completely green, and we're going to have a green economy, and we passed a law which basically sort of says that politicians will be held to account if we don't really make progress towards Paris targets and so on. So there is quite a lot happening at the moment, which makes me feel that ESG flows are going to be sustainable for quite some time to come. Having said that, there is always that caveat that, when too much money chases a particular strategy, like we've seen with tech stocks, for example, then, sooner or later you see some kind of correction. So, we may see correction if investors get too exuberant about ESG. But at this point in time, I'm not really sort of seeing prospects for big correction until quite some time to come, if our survey results are to be believed. Okay,
Amin. I guess we can conclude here. I would like to thank you very much for this fascinating talk. I would also like to thank the audience for interacting with us. May I say before we conclude that the Institute of Finance and Financial Regulation is going to hold a big conference on the 20th and 21st of January 2021, which is going to be on asset management for pension funds. We're going to have a fantastic lineup of speakers, and we will send you the information probably by the end of this week. In the meantime, I would like to wish you all a Merry Christmas. Merry Christmas to you, Amin, as well. I guess it's really cold right now in UK.
Yeah, it is very cold today.
So it feels Christmas. So thank you very much for being with us, and we're looking forward to hearing you on your next survey next year, hopefully.
May I thank you again, George, and thank all the members of the audience for listening to this webinar. And George has got my email address. If anybody wants to get in touch and get more information, I'll be delighted to network with you. But for now, I thank you again for your attention, and also thank you for the privilege of speaking to so many of you today. Thank you.
Thank you very much, Amin. Have a nice evening. Bye-bye.
You too. Thank you. Bye-bye.